let's look at some examples of our fourth qualitative characteristic, Q4, which is verifiability. So verifiability, the first sort of example we'll look at is what about, we always got to have source documents to verify or prove transactions that have occurred. So at the end of 2021, a business is preparing its 3 financial reports. But because the owner has not kept thorough records of all transactions during the period, he has made some estimates of the following items. In the income statement, he guessed that one sale to a client was either 5,900 or 95. He couldn't remember which was which, so he just went with 9,500 because it's higher. What else did he do? Well, the monthly phone bill is usually, it's different each month. It's usually between 180 and 220. And he couldn't be bothered hunting down each bill, so he said, you know what? Let's average it out and say it was $200 per month. In the cash flow statement, one of the firm's clients claims they've paid off their account with the business, but the business says it's still outstanding. So the owner didn't record any cash that's come in because the client says, they have paid it, but we can't find a record. So he said, no, you haven't paid it. The loan repayments to the bank come out of the firm's account via direct debit. You'll learn this when you're an adult. Direct debit, it's a good thing and a bad thing, but basically you can pay all your bills each month that directly comes out of your bank account. Another party charges you, like a bank or your gym or even your phone, okay? So you can lose track of this very easily. So in this case, the bank has been taking direct debits each month, but a different amount. So the owner is a bit unsure exactly how much was paid. So they said, I reckon it's about $15,000 in loan repayments for the year. What about the balance sheet? The stockroom of the business had so much inventory in it that it was too difficult to count it all. So at the end of the year, the owner took a look and said, that's about $50,000 worth of inventory. And lastly, the owner does remember paying a tax bill during the year, but couldn't remember, was it for income tax, which is a tax you pay on your profits, or was it for GST, the goods and services tax? So to be conservative, the owner just said, you know what, I'll just say both were unpaid, and they're unpaid debts at the end of the year. Are any of these decisions acceptable under verifiability? No, they're not. We cannot have estimates and guesses, particularly for transactions, all right? Like transactions, there should be a source document to verify every single thing that happened here. And look, take, this one, for example, it might be a pain to go and look that up, or a pain to look up each of the phone bills, but you have to do it. You should be doing it as it happens. When we look at timeliness, that's another qualitative characteristic. When transactions happen, record them. And that way there'll be source documents to verify each of these items. What about verifiability with asset values? We're going to get this a lot during the year. And we'll say here, a business is preparing its balance sheet and is having difficulty determining the correct amount to show for the following assets. So let's take the property. Original value, it was bought in 1999 for $350,000. The current value, well, you got to insure property. So you don't, let's say it burnt down, you don't want to be insured for $350. Because that's not going to get you much today. So it should be insured for its current value. So the owner says, you know what, I reckon it's about $680,000. What about with stock? That's an asset. Inventory. Let's say this is a business that sells mobile phones. There are 100 units of the iPhone left in inventory that we didn't sell when we bought them in 2017. Maybe we bought, 10,000 of them. There's still 100 left at $800 each. That's what we paid. Is that the value today? Nah. This model's now been superseded by many new iPhone models. You're not going to be selling it for $800, and that's just its cost. So the owner reckons they could probably be sold for around $500. You're going to take a loss on these phones. Okay, that's just a fact of life, and we'll deal with that as a topic later in the year. It's called net realizable value. And what about this one? An account receivable. That's someone who owes me money. A client owes me $2,300 for a phone they bought on credit earlier this year. I've just found out through a mutual acquaintance that this client is broke and about to declare bankruptcy, meaning they'll never pay me that. So really the value of this money is zero. This asset should be zero. But with verifiability, which one should we use? Should we use the original value or the current value? Well, verifiability clearly says we've got to use the original values. Why? There are source documents as old as they are. There's a source document from 1999 to prove that. There's a source document from 2017 to prove that. And there's a source document to prove that this person owes me $2,300. These seem to be more accurate in today's sort of value, but we can't use them under verifiability. Why? Because they all involve an element of an estimate, a guess, or subjectivity. I guess the question now becomes, well, a lot of these values are stupid. That value is stupid. That value is stupid. That value is stupid. They don't reflect reality. They're not relevant to today's decisions. And that's because there's going to be a real big conflict between relevance and verifiability. But we'll look at that in another video and say, actually, verifiability is a bit flexible. Maybe we can use some of these. But we'll look at that in a video later on.